There is a lie at the heart of the entire financial world, a multi-trillion-dollar illusion whispered every single day on television, in newsletters, and across the polished tables of executive boardrooms. It's a lie so seductive, so deeply intertwined with our human desire for control, that we have built an entire global industry around its propagation. The lie is this: that someone, somewhere, knows what is going to happen next. They'll tell you where the S&P 500 will be in 6 months. They'll predict the next move by the Federal Reserve. They will forecast, with charts and graphs and unwavering confidence, the precise trajectory of the economy. And Warren Buffett, the man who has compounded wealth more successfully than any human being in modern history, has built his entire philosophy, his entire fortune, on a single liberating truth: nobody knows anything. That entire apparatus of prediction is a scam. It is not just useless noise, it is a dangerous poison, engineered to separate you from your money by appealing to your most destructive emotional instincts. This is not a simple rejection of expert opinion. It is a profound insight into the nature of complex systems, human psychology, and the true source of investment returns. To embrace this idea is to unplug from a machine that manufactures anxiety and encourages self-defeating behavior. It is to find a place of quiet clarity in a world of deafening financial noise. The goal is not to become better at predicting the future. The goal is to build a financial fortress, a strategy so robust, so grounded in knowable reality, that the future, in all its chaotic uncertainty, becomes irrelevant. We are not here to learn how to read tea leaves. We are here to learn how to buy wonderful businesses at prices so fair they provide their own protection against the unknowable. We are going to deconstruct Buffett's radical skepticism, piece by piece, and in doing so, assemble an intellectual framework that will make you immune to the siren song of the forecasters. This is a journey to reclaim your focus, to anchor your decisions in value instead of vapor, and to understand the final promise of an investment philosophy that has weathered every storm for over half a century, the promise of peace of mind in the pursuit of building wealth. Our exploration begins with the foundational flaw in the very idea of prediction, the illusion of precision in a world that is fundamentally, irreducibly complex. Warren Buffett's entire career can be seen as a long argument against the hubris of forecasting. He has famously said, "Forecasts may tell you a great deal about the forecaster. They tell you nothing about the future." This isn't just a witty aphorism, it's the bedrock of his risk management. To truly understand its power, we must travel back to a single day that ripped through the heart of Wall Street, a day that vaporized fortunes and exposed the utter bankruptcy of prediction. October 19, 1987, Black Monday. In the sun-drenched pre-crash days of 1987, the mood on Wall Street was euphoric. The Dow Jones Industrial Average had surged over 40% since the start of the year. The architects of this bull run, the titans of finance and the economists who advised them, were celebrated as prophets of a new era of prosperity. Their forecasts were universally rosy. They spoke of sophisticated new tools like portfolio insurance and computerized trading that had, they claimed, tamed the market's volatility. They assured the investing public that the good times were not just here to stay, but were accelerating. There was no significant chorus of Cassandras predicting an imminent collapse. The financial media, in its role as chief cheerleader, amplified these predictions, creating a feedback loop of unshakable confidence. The economic forecast called for continued growth. The stock market prediction was for blue skies ahead. Meanwhile, in Omaha, Nebraska, Warren Buffett was not listening. He wasn't consulting economists or running complex models to predict the market's next move. He was doing what he always does, reading annual reports and thinking about businesses. He was looking at companies like Coca-Cola, the Washington Post, and his own burgeoning collection of insurers and manufacturers under the Berkshire Hathaway umbrella. His decision-making process had nothing to do with the Dow's level or the latest GDP print. It was about a series of simple, yet profound, questions. Is this a business I can understand? Does it have a long-term, durable competitive advantage? Is its management able and honest? And is it available at a sensible price that provides a margin of safety? He was focused on what was knowable, on the intrinsic value of productive assets. Then, the storm hit. On Monday, October 19, 1987, the Dow plummeted 508 points, a staggering 22.6% drop in a single session. It was and remains the largest one-day percentage loss in the index's history. The sophisticated portfolio insurance models, which were supposed to prevent such a crash, instead became an accelerant, unleashing waves of automated selling that fed on themselves in a terrifying cascade. The confident forecasters of the week before were now stammering on television, their complex models shattered, their credibility annihilated. Panic gripped the globe. Investors who had been guided by the rosy stock market predictions were now guided by raw, primal fear. They dumped their holdings at any price, desperate to escape the carnage. Their wealth, built on the flimsy foundation of forecasts, was evaporating in real time. And what was Buffett doing? He was calm. He wasn't selling. In fact, in the aftermath, he was looking for opportunities. He famously told a reporter, "It's an ideal time to be a buyer of businesses." While others saw a cataclysm, he saw a clearance sale. The value of Coca-Cola's brand, the loyalty of its customers, the efficiency of its global distribution system, none of that had changed between Friday and Monday. The company was just as good, just as profitable. What had changed was its price tag. The manic-depressive Mr. Market was in a suicidal panic, and he was offering to sell his shares in wonderful businesses at absurdly low prices. Buffett, whose entire strategy was divorced from market timing, was uniquely positioned, both financially and psychologically, to take advantage of it. He didn't predict the crash, and he didn't need to. His rejection of economic forecasts had rendered him immune to the panic they inevitably create when they prove false. This event was a stark, brutal lesson. The value of a business is a matter of long-term reality. The price of its stock is a matter of short-term emotion. The forecasters live in the world of emotion. The intelligent investor lives in the world of reality. Building wealth is not about correctly guessing the weather. It's about owning the farm, knowing that over seasons it will produce a harvest, regardless of any single storm. The deep-seated human craving for forecasts, and the willingness of so-called experts to provide them, is not just a quirk of financial markets. It's a direct result of powerful cognitive biases hardwired into our brains. At the core of this entire charade lies the overconfidence effect, a well-documented psychological principle, where an individual's subjective confidence in their judgments is reliably greater than their objective accuracy. When you see a smartly dressed analyst on a financial news network declare with absolute certainty that the market is headed for a 10% correction, you are not witnessing a feat of sophisticated analysis. You are witnessing a textbook display of the overconfidence effect. This bias is particularly potent in fields where outcomes are complex and feedback is noisy, like economics and finance. The analyst makes a prediction. If they are right, they attribute it to their own genius, reinforcing their overconfidence. If they are wrong, they attribute it to an unforeseeable black swan event or some other external factor, allowing their self-assessed expertise to remain intact. Their brain is a master of self-deception, protecting their ego at the cost of truth. Working in tandem with this is another powerful bias, the illusion of control. Humans have an innate need to believe they can exert control over outcomes, even when they are clearly random. It's a survival mechanism. Our ancestors who believed they could influence the hunt through rituals were more likely to have the confidence to actually go on the hunt. In the modern world, this translates into believing that by consuming enough information, by reading enough charts, by listening to enough forecasts, we can control the outcome of our investments. The financial media is a multi-billion-dollar machine built to service this illusion. It provides a constant stream of data, predictions, and narratives that give us the feeling of being informed and in command, even as we are simply reacting to random noise. Warren Buffett's genius is not just financial, it's psychological. He has waged a lifelong war against these biases. He understands that the first step to successful portfolio management is admitting what you don't know and cannot control. He recognizes that the human brain is not naturally wired for long-term investing. It is wired for short-term survival, for reacting to immediate threats and opportunities. The constant chatter of economic forecasts triggers this primitive wiring, pushing us to act, to do something, when the most profitable course of action is almost always to do nothing. By dismissing all forecasts, Buffett is short-circuiting this flawed psychological process. He is refusing to play a game that is rigged by his own cognitive limitations. This is a crucial insight for anyone serious about building wealth. Your own mind is your greatest enemy, and the forecasters are the ones loading its weapons. So if we are to reject the world of prediction, how do we operate? We need a practical, applicable mental model to replace the flawed instinct to listen to so-called experts. For this, Buffett provides an elegant and profoundly effective tool, the circle of competence. This is not just a folksy saying. It is a rigorous blueprint for intellectual honesty and disciplined decision-making. The process is a systematic way to separate what is knowable and important from what is unknowable and distracting. Step 1 is to take out a blank sheet of paper and, with brutal honesty, define what you truly understand. This is your circle. What industries do you know inside and out, perhaps from your own career or a lifetime of study? Maybe it's consumer retail, maybe it's enterprise software, maybe it's residential real estate. The key is that your knowledge must be deep. You should understand the competitive landscape, the key drivers of profit, the potential threats, and the customer behavior. You should be able to explain how the core businesses in this industry make money as if you were explaining it to a 10-year-old. For Buffett, this circle includes things like insurance, railroads, utilities, and simple consumer brands. He knows how they work, how they are valued, and what makes them durable. Step 2 is just as important. Define what is outside your circle. This list will be vastly longer. For almost everyone, it should include things like macroeconomic forecasting, predicting interest rate movements, guessing the direction of commodity prices, understanding complex biotechnology, or forecasting geopolitical events. This isn't an admission of ignorance. It's an act of supreme intelligence. It is the active, conscious recognition of your own limitations. The failure to do this is the primary cause of investment disaster. A dentist who has mastered his craft suddenly believes he can predict the price of oil. An engineer who builds brilliant software thinks she can time the currency markets. They are stepping outside their circle of competence, and in doing so, they are transforming from investors into speculators. Step 3 is to draw a hard, impenetrable line between these two lists. This is your intellectual fence. Your personal investment mandate is now simple. You are only allowed to make decisions on things that fall squarely inside the circle. Everything outside is off-limits. It is treated as unknowable noise. When an expert on TV starts talking about where the GDP is headed next quarter, you can now categorize it correctly. Outside my circle. Irrelevant to my process. This act of categorization is a powerful psychological tool. It defangs the constant stream of financial media, turning it from an anxiety-inducing call to action into a stream of harmless, irrelevant data points. Step 4 is the execution. Make all your investment decisions with this framework. When you evaluate a company, the first question is not, what is the stock market prediction for this sector? The first question is this business inside my circle of competence? If the answer is no, you stop. The analysis is over. You move on, no matter how exciting the story sounds. If the answer is yes, only then do you proceed to the deeper analysis of its competitive advantages, management, and valuation. This blueprint, define your circle, acknowledge what's outside it, build a fence, and operate strictly within it, is the practical antidote to the poison of forecasting. It replaces the futile quest for omniscience with the humble and vastly more profitable pursuit of deep, focused knowledge. It is the foundation of a portfolio management strategy built on rock, not sand. To fully appreciate the wisdom of this path, we must examine its opposite. We must walk the path of the 99%, the path of the market timer. This individual lives and dies by the forecast. Their day begins not with a company's annual report, but with the pre-market futures report. Their emotional state is a direct reflection of the squiggly lines on their screen. They are perpetually trying to solve a puzzle that has no solution, getting in right before the market goes up and getting out right before it goes down. The market timer subscribes to multiple newsletters, each offering a different, often contradictory, stock market prediction. They have their favorite television pundits, whose confident pronouncements they take as gospel. They see the economy not as a complex, adaptive system, but as a machine that can be reverse-engineered and predicted if only they find the right indicator. Let's follow a typical journey. In early 2021, the forecasts are overwhelmingly bullish for high-growth technology stocks and speculative assets. The market timer, fueled by a potent cocktail of FOMO and expert consensus, piles their capital into these names. They ignore traditional valuation metrics, because the prevailing narrative, the forecast, is that this time it's different. For a while, they feel like a genius. Their portfolio soars. They have successfully timed the market. But then, in 2022, the music stops. Inflation appears, and the Federal Reserve begins to raise interest rates. The economic forecast shifts dramatically. The same pundits who were bullish a year ago are now predicting a deep recession. The market timer, seeing their portfolio plummet, panics. They sell everything, locking in massive losses. Their new strategy, based on the new forecast, is to hold cash and wait for the all-clear signal. For months, they sit on the sidelines, watching the market chop sideways. They feel smart for having avoided further losses. Then, in 2023, the market begins a surprising and powerful recovery, even as the recession forecasts continue to blare. The market timer is paralyzed. The experts are still bearish, but the market is rising. This conflicts with their model. They wait for a pullback that never comes. By the time they finally capitulate and buy back in, fearful of missing the entire rally, the market is already significantly higher than where they sold. They have successfully executed the speculator's creed: buy high, sell low. This isn't a caricature, it is the documented experience of millions. The market timer is engaged in a high-stress, high-cost endeavor. Every trade incurs transaction fees. Every short-term gain is taxed at a higher rate. But the greatest cost is psychological. They are living in a state of perpetual anxiety, their well-being tethered to the unpredictable whims of the market. They have outsourced their thinking to forecasters, becoming a puppet whose strings are pulled by financial news headlines. They will never experience the quiet confidence of owning a great business because their focus is not on the business at all, it's on the price and the endless, futile attempt to guess its next move. This is the path of guaranteed mediocrity, a treadmill of activity that leads to financial and emotional exhaustion. The distinction between Buffett's forecast-agnostic approach and the market timer's frenetic activity is not merely philosophical, it manifests directly and powerfully on the balance sheet. The direct financial connection is twofold: the preservation of capital through lower taxes and the enhancement of returns through reduced turnover. Let's quantify the impact. Imagine two investors, each starting with $100,000. The market timer, investor A, follows the forecasts. They buy and sell frequently, chasing trends. Let's say they achieve a respectable 12% average annual return times times taxes and fees. However, because they are trading, most of their gains are short-term, taxed at their ordinary income tax rate, which we'll assume is 35%. Each year, 35% of their 12% gain, or 4.2% of their total capital, is lost to taxes. Their actual after-tax return is only 7.8%. Now consider investor B, who follows the Buffett model. They ignore the economic forecast. and focus on buying a handful of great businesses within their circle of competence at fair prices. Their strategy is one of lethargy bordering on sloth. They might only make 1 or 2 transactions in a year, or even go years without buying or selling anything. Let's assume they also achieve a 12% average annual return, but their gains are almost entirely unrealized. They are not selling their winners, so no capital gains tax is due. The money that Investor A is sending to the government each year is staying inside Investor B's portfolio, working for them, compounding on their behalf. After 30 years, Investor A, the market timer, would see their initial $100,000 grow to approximately $940,000, a handsome sum. But Investor B, the long-term owner, whose capital was allowed to compound tax-deferred, would see their initial investment grow to over $2.8 million. That is a staggering difference of nearly $2 million, created not by being a better stock picker, but simply by adopting a structure that minimized the friction of taxes. The government becomes a silent partner in the market timer's portfolio, taking a significant cut every year. For the long-term owner, the government only gets paid once, at the very end, and at a potentially more favorable long-term capital gains rate. This is the hidden mathematical power of ignoring forecasts and the activity they encourage. It turns your portfolio from a leaky bucket into a watertight vessel for compounding, creating a massive tangible financial advantage over the long run. The refusal to engage in stock market prediction is one of the most profitable financial decisions an investor can ever make. The second pillar of Buffett's philosophy builds directly upon the first. If forecasts are inherently flawed, then the constant stream of predictions emanating from the financial media is not just neutral noise, it is a poison that encourages destructive behavior. The primary sin it promotes is activity. Every forecast, every bold prediction, every breaking news alert is an implicit call to action. It screams, "Do something! The world has changed. Your portfolio must change with it." Buffett, in stark contrast, preaches the virtue of what he calls inactivity bordering on sloth. This is not laziness. It is a deliberate, strategic defense mechanism against the greatest enemy of the long-term investor, the urge to constantly meddle. To grasp the life-or-death importance of this principle, we must journey back to the final years of the 20th century, to the mania of the dot-com bubble. In the late 1990s, the world was intoxicated by the promise of the internet. A new economy was being born, and with it, a new set of rules for investing. Or so the story went. Forecasters, analysts, and the financial media fell over themselves to predict a future of limitless, frictionless growth. They spoke of a new paradigm, where old metrics like profits and earnings were obsolete. The only thing that mattered was eyeballs, clicks, and growth at any cost. Companies with no revenue, no profits, and often no viable business plan were going public and seeing their stock prices multiply overnight. The stock market prediction was not just for growth. It was for a permanent high plateau of prosperity, a digital utopia. The pressure to participate was immense. Every day, stories of instant millionaires, of secretaries and janitors cashing in on tech IPOs, dominated the news. To be on the sidelines was to be a fool, a dinosaur, an artifact of a bygone era. And on the sidelines is exactly where Warren Buffett was. From his quiet office in Omaha, he watched the mania unfold with a mixture of amusement and bewilderment. He was publicly, and often harshly, criticized. Magazine covers branded him as out of touch. Prominent analysts declared that his value investing philosophy was dead, a relic of an industrial economy that no longer existed. Berkshire Hathaway's stock, for the first time in a long time, was dramatically underperforming the S&P 500. The pressure on him, from his own shareholders and the entire financial world, to abandon his principles and join the party was unimaginable. But Buffett did not budge. Why? Because the new paradigm stocks were far outside his circle of competence. He admitted openly that he had no idea how to value these companies. He couldn't project their cash flows 10 years into the future because he wasn't sure they would even exist in 10 years. The forecasts of endless growth were based on hope, not on the durable business realities he insisted upon, so he did nothing. He sat on his hands, holding cash and his collection of old economy businesses like Coca-Cola and Gillette, and waited. His inactivity was a powerful, active choice. It was a declaration that he would rather be criticized for missing a party than be bankrupted by the hangover. Then, in March of 2000, the bubble burst. The Nasdaq, which had soared above 5,000, began a brutal, gut-wrenching collapse. Over the next 2 years, it would fall nearly 80%. Companies that were once worth billions went bankrupt. The new paradigm was revealed to be the same old story of speculative excess. The paper fortunes of the dot-com millionaires vanished as quickly as they had appeared. And Warren Buffett, the dinosaur, was suddenly hailed as a genius once again. His refusal to act, his commitment to inactivity in the face of overwhelming social pressure, had preserved Berkshire's capital from catastrophic losses. While others were nursing devastating hangovers, Buffett was now armed with a mountain of cash in a market where wonderful businesses were finally on sale at reasonable prices. The dot-com bubble is the ultimate parable of our theme. It demonstrates that the financial media's forecasts are not just predictions. They are narratives. And during a mania, these narratives become incredibly powerful, creating a reality of their own, for a time. The true test of an investor is not their ability to see the future, but their ability to resist a seductive story that has captivated everyone else. The most profitable action Buffett took between 1998 and 2000 was no action at all. The immense pressure that Buffett resisted during the dot-com boom is not an abstract economic force, it is a deeply human, psychological phenomenon. The urge to act on forecasts and follow the crowd is driven by two of the most powerful biases in behavioral finance: herd mentality, also known as social proof, and the fear of missing out, or FOMO. Our brains are wired for social cohesion. For millennia, our survival depended on our ability to stick with the tribe. Being cast out meant almost certain death. This evolutionary programming manifests in modern financial markets as an intense psychological discomfort with being different. When everyone around you is buying tech stocks and getting rich, your brain interprets this as a signal that the herd has found a new, lush pasture. The pain of standing alone, of not participating, can be overwhelming. The financial media acts as the tribal drumbeat, amplifying the consensus and making it seem like the only rational choice. Everyone is doing it. The headlines scream, "You should too." This is social proof in action. We assume that the actions of others reflect correct behavior for a given situation. This is a useful shortcut in many areas of life, but in investing, where the crowd is often most wrong at the very peaks and troughs of the market, it is a recipe for disaster. FOMO is the emotional engine of herd mentality. It's that nagging, gut-wrenching feeling that others are experiencing something rewarding from which you are absent. It's not just about greed. It's about regret. The fear of future regret, the "what if it keeps going up and I'm not in," can be a more powerful motivator than the fear of actual loss. During the dot-com bubble, investors weren't just buying stocks. They were buying a lottery ticket to avoid the regret of not being part of the biggest wealth creation event in a generation. The constant stream of forecasts predicting ever higher prices for tech stocks was essentially a marketing campaign for this lottery. It stoked the flames of FOMO, encouraging people to abandon their long-term investing plans and join the speculative frenzy. Buffett's commitment to inactivity is a conscious and deliberate countermeasure to these powerful psychological forces. He has effectively trained himself to view the herd's behavior as a contrary indicator. When the financial media is universally bullish and social proof is at its peak, he becomes more cautious. When the headlines are apocalyptic and the herd is stampeding for the exits, he becomes more interested. This requires an almost superhuman level of emotional detachment. He is not immune to feelings of FOMO or the discomfort of being an outlier. He has simply developed a rational framework so strong that it can override these primal emotional signals. He understands that in the world of investor psychology, the path to safety is often the one that feels the most uncomfortable. By refusing to act on forecasts, he starves the beasts of herd mentality and FOMO, preventing them from hijacking his decision-making process and leading him over the same cliff as everyone else. To operationalize this immunity to herd behavior, we need a practical mental model that can be used in the heat of the moment. Buffett's mentor, Benjamin Graham, provided the single most powerful tool for this purpose in his book, The Intelligent Investor *, The Allegory of Mr. Market. This is not just a charming story, it is a blueprint for maintaining your sanity and capitalizing on the market's emotional swings. Step 1 is to personify the stock market. Imagine you are a co-owner in a private business, and your only partner is a man named Mr. Market. He is a very accommodating partner. Every single day, without fail, he shows up and offers to either buy your share of the business or sell you his share. The critical thing to understand about Mr. Market is that he is a manic depressive. Some days, he arrives in a state of wild euphoria. He sees only a glorious, cloudless future for your business. On these days, he will offer to buy your stake at a ridiculously high price. Other days, he shows up in the depths of a suicidal depression. He is convinced the business is doomed and the world is ending. On these days, he will offer to sell you his stake for pennies on the dollar. Step 2 is to define your relationship with him. Mr. Market is your servant, not your guide. You are under no obligation to trade with him. You do not have to listen to his forecasts or get infected by his mood. He is simply there to offer you a price. His emotional state, the narrative he is spinning today, is completely irrelevant to the underlying value of the business you co-own. Step 3 is the application of the model. When Mr. Market shows up euphoric, quoting prices that are far above your own careful calculation of the business's intrinsic value, you have two choices. You can politely ignore him, or, if the price is truly absurd, you can sell your share to him. When he shows up in a panic, offering to sell you his stake at a price far below your calculation of its value, you should gladly take him up on his offer and increase your ownership. The key is that your decision is never driven by his mood. It is always driven by the gap between the price he is offering and the value you have independently determined. This mental model is a game changer. It transforms the market from a menacing, all-knowing entity that you must obey into a slightly deranged but ultimately useful business partner. The daily stock market prediction you hear on the news is just Mr. Market having one of his episodes. The market crash is just Mr. Market in a deep depression, offering you a bargain. The speculative mania is just Mr. Market in a state of euphoria, offering to overpay you for your assets. By consistently applying this blueprint, you can insulate your decision-making from the emotional contagion of the market. You stop asking, "What is the market going to do next?" and start asking, "What is Mr. Market offering me today, and how does that compare to what I know this business is worth?" This is the intellectual foundation for contrarian investing and the ultimate defense against the poison of activity. The alternative to the disciplined path of the intelligent investor is the chaotic journey of the headline investor. This individual's portfolio management strategy is a direct reflection of the last 6 months of financial media headlines. They have no anchor in intrinsic value. Their only guide is the prevailing narrative, the ever-shifting forecast peddled by the news cycle. Let's trace their destructive path. In a bull market, when the economic forecast is positive and stories of growth abound, the headline investor is all in. They buy the stocks that are featured on magazine covers, the companies with the most exciting stories. Their portfolio becomes a concentrated bet on whatever is popular, because popularity is their only metric of quality. They feel smart and validated as their portfolio rises with the tide. Then, the narrative shifts. A geopolitical conflict arises, or an inflation report comes in hotter than expected. The financial media, which thrives on fear and urgency, pivots on a dime. Headlines that once screamed of opportunity now blare warnings of recession and market volatility, The headline investor, who has no independent conviction, is terrified. Their portfolio, once a source of pride, is now a source of intense anxiety. They see the pundits who were bullish just weeks ago now gravely predicting a bear market. So they sell. They are not selling because the long-term prospects of their businesses have changed, but because the headlines have changed. Now they are in cash, waiting for the storm to pass. They watch the news daily for the all-clear signal, but the media rarely provides one. The news is always a mix of good and bad. The market eventually bottoms and begins to recover, often while the headlines are still at their most negative. The headline investor misses the initial, most powerful leg of the recovery because they are waiting for a forecast that gives them permission to feel safe again. By the time the news turns positive and they feel confident enough to buy back in, the market has already reclaimed a significant portion of its losses. They have been whipsawed, selling near the bottom and buying back higher up. Over an investing lifetime, this pattern repeats itself. They buy into the euphoria of the dot-com bubble, sell in the panic of 2002, buy into the housing boom of 2006, sell in the financial crisis of 2008, and so on. Their long-term return is a fraction of what they would have achieved by simply buying a diversified portfolio and holding on. The headline investor is a perpetual victim of the financial noise machine, a pawn in a game designed to generate clicks and trading commissions, not sustainable wealth. They are always reacting, never anticipating, and their portfolio is the casualty. The devastating consequences of this behavior are not theoretical. They are brutally quantified in what is known as the behavior gap. This is the well-documented difference between the published returns of an investment, like a mutual fund, and the actual returns that the average investor in that fund receives. Research firms like Dalbar have studied this phenomenon for decades, and their findings are a shocking indictment of the forecast-driven, headline-reacting approach to portfolio management. For example, over a 30-year period, the S&P 500 might generate an average annual return of, say, 10%. This is the asterisk investment return. However, the average equity fund investor over that same period might only earn a return of 6 or 7%. This difference of 3 to 4 percentage points per year is the behavior gap. What causes this massive shortfall? It's not high fees or bad fund selection, although those can be factors. The overwhelming cause is bad timing. It is the direct financial result of listening to forecasts and reacting to headlines. The average investor, a classic headline investor, pours money into the market after a period of strong performance, when the news is good and the forecasts are bullish, effectively buying high. Then, when the market inevitably corrects or enters a bear market and the headlines turn negative, they panic and sell, effectively selling low. This destructive cycle of chasing performance and fleeing from volatility systematically destroys their returns. The behavior gap is the price tag for a lack of emotional discipline. It is the tax you pay for listening to the financial media and believing in the illusion of stock market prediction. A 3% annual gap may not sound like much, but over an investing lifetime, the impact of this self-inflicted damage is catastrophic. Let's revisit our two investors, each with $100,000. Investor B, the buy and hold investor, earns the market's 10% return. After 30 years, their portfolio grows to $1.74 million. Investor A, the headline investor, earns only 7% due to the behavior gap. After 30 years, their portfolio is worth just $760,000. That is a difference of nearly $1 million. The money didn't vanish into thin air, it was transferred from the anxious reactor to the patient owner. It was sacrificed at the altar of market timing and emotional decision-making. This is the quantifiable, undeniable financial cost of consuming the poison of forecasts. It demonstrates that in the business of building wealth, behavior is more important than analysis, and temperament is more important than intellect. The best way to close the behavior gap is to shut out the financial noise that creates it in the first place. This leads us to the constructive heart of Buffett's philosophy. If we reject forecasts and ignore the noise, what do we anchor ourselves to? The answer is the third pillar, the fortress of value. A robust investment strategy cannot be built on the shifting sands of prediction. It must be built on the bedrock of knowable, durable facts. The goal is to build a portfolio of businesses that is fundamentally immune to the future's uncertainty. This means focusing intensely on two things: a company's intrinsic value and its durable competitive advantage, or what Buffett famously calls its moat. This approach shifts the entire game from guessing stock prices to analyzing businesses, a pursuit where diligence and rational thought can provide a genuine edge. The perfect illustration of this principle in action is one of the most important acquisitions in Berkshire Hathaway's history: the purchase of See's Candies in 1972. The year was 1972. The United States was mired in the economic malaise of stagflation, a toxic combination of high inflation and stagnant economic growth. The prevailing economic forecast was grim. Pundits worried about rising oil prices, wage price spirals, and a general sense of national decline. It was not a time of unbridled optimism. In this environment, Warren Buffett and his partner Charlie Munger were presented with an opportunity to buy a family-owned candy company based in California called See's Candies. On the surface, it seemed unremarkable. It was an old economy business in a low-growth industry. It didn't have any revolutionary technology or a story that would excite a Wall Street analyst. Most investors, guided by the gloomy macroeconomic outlook, would have passed on it without a second thought. They would have said, why buy a candy company when a recession is right around the corner? But Buffett and Munger weren't asking that question. They were not interested in the economic forecast. They were interested in the business itself. They began their analysis by asking questions that were completely independent of the macro environment. What they discovered was a commercial fortress. For decades, See's had built an absolutely fanatical customer following in California. The brand was associated with quality, nostalgia, and cherished family traditions. This gave the company tremendous pricing power. Every year, they could raise the price of their boxed chocolates, and customers would happily pay it because the emotional connection to the product was so strong. They didn't check the price of a competitor's box. They just bought See's. This brand loyalty was a deep, unbreachable moat protecting the company's profitability from competition. Furthermore, they discovered that the business was a cash-generating machine. It required very little capital to grow. They didn't need to build massive new factories or spend fortunes on research and development. The cash that the business produced each year could be taken out and deployed elsewhere. Buffett and Munger calculated the company's intrinsic value based on these, quote, owner earnings, the true measure of its cash-generating power. They determined the business was worth more than the $25 million asking price. They saw a wonderful business with a durable moat, run by able management, available at a fair price. They ignored the gloomy forecasts about stagflation and bought the company. It turned out to be one of the best investments they ever made. See's Candies has since generated over $2 billion in cash for Berkshire Hathaway, money that was used to buy other businesses and fuel Berkshire's incredible growth. The lesson is profound. A truly great business, one with a powerful brand and pricing power, can thrive in almost any economic environment. The 99% were worried about the next year's GDP. Buffett was focused on the next 20 years of customer loyalty. By building his decision on the durable, knowable facts of the business, he made the unknowable future of the economy irrelevant. The ability to hold a business like See's Candies through thick and thin, ignoring the constant chatter about the economy, is not just an analytical skill, it is a psychological one. The act of doing deep research and building a fortress of value activates several powerful cognitive principles that work in your favor. Chief among these is the endowment effect, our tendency to value something more highly simply because we own it. In many contexts, this is a bias to be overcome, but in long-term investing, it can be harnessed for good. When you have spent dozens of hours studying a company, reading its annual reports for the last decade, analyzing its competitors, and building your own detailed valuation model, you become psychologically endowed with that knowledge. You own the analysis. This deep sense of ownership makes you far less susceptible to being shaken out of your position by a scary headline or a negative stock market prediction. You know the business better than the pundit on TV who has spent 5 minutes glancing at a stock chart. Your conviction is not borrowed, it is earned. This works in concert with the commitment and consistency bias. We have a deep psychological need to be consistent with our past decisions and commitments. Once we have made a stand or gone on record, we will face internal and external pressure to behave consistently with that stance. When you make the conscious commitment to be a long-term owner of a business, not a short-term renter of its stock, you create a powerful psychological barrier against impulsive action. Your identity shifts from speculator to business owner. A speculator asks, "What will the stock do tomorrow?" A business owner asks, "How will this business perform over the next 10 years?" By committing to the identity of a business owner, you automatically filter out the short-term noise and forecasts as irrelevant to your mission. Your deep-seated need for consistency will help you stick to your plan during periods of market volatility. Instead of viewing a price drop as a reason to panic, your consistency bias will frame it as an opportunity to be consistent with your belief in the company's long-term value by buying more. These psychological forces, when rooted in a foundation of diligent, value-based analysis, create a virtuous cycle. The hard work of valuation builds commitment, and that commitment provides the emotional stability needed to ignore forecasts and allow a long-term strategy to work its magic. To translate this theory into a practical instruction manual, we can use a powerful mental model that Buffett employs, the 10-year test. This is a step-by-step checklist for evaluating a potential investment through the lens of a long-term business owner, effectively forcing you to ignore the short-term financial noise. Step 1 is the test of predictability. Ask yourself, can I confidently predict, in broad strokes, what this industry and this company's role in it will look like in 10 years? This is a crucial first filter. For Buffett, it's easy to predict that people will still be drinking Coca-Cola, chewing Wrigley's gum, and using American Express cards in a decade. It is much harder to predict which company will dominate a rapidly changing high-tech industry. If you cannot form a reasonably confident picture of the 10-year future, the company fails the test. This step immediately eliminates the vast majority of speculative ventures and focuses you on businesses with enduring demand. Step 2 is the test of the moat. Does the company have a durable competitive advantage that will protect its profits from being eaten away by competitors over the next decade? Identify the specific source of this moat. Is it a powerful brand like See's Candies? Is it a low-cost production process like Geico? Is it a network effect, where the service becomes more valuable as more people use it like American Express? Is it a regulatory advantage or a patent? You must be able to clearly articulate the nature and durability of the moat. A company without a moat is a sitting duck, and its long-term future is unpredictable. Step 3 is the test of management. Is the management team both able and honest? Have they demonstrated a talent for allocating capital intelligently? Do they treat shareholders as true partners? You can assess this by reading their shareholder letters, looking at their track record of acquisitions and buybacks, and evaluating their compensation structures. You are looking for managers who think like owners, not like employees trying to maximize their next bonus. This is critical because over a 10-year period, the decisions of management will have a huge impact on the company's intrinsic value. Step 4 is the test of price. Is the current stock price sensible in relation to the company's long-term earnings power? This is where the concept of margin of safety comes in. You want to buy the business for significantly less than your conservative estimate of its intrinsic value. This discount provides a cushion against bad luck, errors in your judgment, or unforeseen negative events. It is the ultimate form of risk management. A wonderful business can be a terrible investment if you pay too high a price for it. By rigorously applying this 4-step 10-year test to every potential investment, you are systematically forcing yourself to think like a business owner, not a speculator. It shifts your focus from the unknowable future of the stock market to the knowable fundamentals of the business. It is a repeatable, disciplined process that builds a fortress of value around your portfolio, rendering the daily barrage of economic forecasts and market predictions completely irrelevant. The antithesis of the value-focused business owner is the speculator. While the investor carefully applies the 10-year test, the speculator operates on a completely different set of principles, if they can be called principles at all. The speculator is not buying a piece of a business, they are buying a story, a hope, a lottery ticket. Their primary thesis is not based on cash flow, but on the belief that someone else, the greater fool, will come along and pay a higher price for the asset tomorrow. Their analysis, if any, is superficial. They are drawn to companies with exciting narratives, disruptive technology, visionary CEOs, or industries that are the flavor of the month. They rarely, if ever, read a company's 10K report. Why bother with boring financials when the story is so compelling? Let's contrast the purchase of See's Candies with a hypothetical purchase made by a speculator during a bubble. The speculator hears about a new company, let's call it Future Corp, that is going to revolutionize an industry using a new, unproven technology. The company has no profits and minimal revenue, but the stock price is soaring. The financial media is filled with breathless coverage of its charismatic founder and optimistic forecasts about the size of its potential market. The speculator, driven by FOMO, buys the stock. They have no idea how to value Future Corp because it has no earnings to value. Their purchase is an act of faith in the story. They are entirely dependent on future events they cannot predict. The technology must work. Competitors must not emerge. The economy must remain strong, and market sentiment must remain euphoric. The investor who bought See's Candies, on the other hand, was not dependent on rosy future scenarios. Their investment was backed by a long history of profits, a loyal customer base, and a sensible purchase price. Even if a recession hit the year after they bought it, the fundamental value was still there. The speculator has no such anchor. When the narrative around Future Corp inevitably changes, perhaps a competitor emerges or the technology proves more difficult to scale than expected, the stock price collapses. The speculator, having no foundation of value to fall back on, panics and sells, crystallizing their loss. The speculator's approach is the embodiment of fragility. It requires the future to unfold in a very specific, positive way. The intelligent investor's approach is the embodiment of robustness. It is designed to succeed even if the future is messy and disappointing, because the value was already present on the day of purchase. This is the fundamental, night and day difference between investing and speculating. This difference finds its ultimate expression in the financial metrics used to justify a purchase. The direct financial connection for the fortress of value approach is the concept of owner earnings and the discipline of discounted cash flow (DCF) analysis. Buffett defines owner earnings as a company's net income, plus depreciation and other non-cash charges, minus the average annual amount of capital expenditures required to maintain the business's long-term competitive position. This figure represents the true amount of cash that the business generates each year that can be distributed to its owners. It is a measure of reality. ADCF analysis then takes these expected future owner earnings for the next 10 or 20 years and discounts them back to the present day to arrive at a single number, the company's intrinsic value. This process, while requiring some assumptions, provides a concrete, rational anchor for decision-making. It tells you what the business is actually worth, completely independent of its current stock price or the prevailing market sentiment. When you have this number, you can compare it to the price Mr. Market is offering and determine if you have a margin of safety. This is a disciplined, business-like approach to valuation. The speculator, in contrast, relies on flimsy, story-based metrics. During the dot-com bubble, companies were valued on price per eyeball. In other recent manias, profitless companies have been valued on a high multiple of their sales, price-to-sales ratio, or even more abstract concepts. These metrics are not tethered to the actual profitability or cash-generating ability of the business. They are simply justifications for paying an ever higher price, based on the hope of future growth that may never materialize. Using owner earnings and a DCF is like measuring a property's value based on the rental income it generates. Using price to sales on a profitless company is like valuing that same property based on how many people walk by it each day. One is a measure of economic reality. The other is a measure of fleeting popularity. By anchoring your decisions in the tangible reality of owner earnings, you are building your financial fortress on a foundation of stone, immune to the winds of economic forecasts and the changing tides of market fashion. Once you have rejected forecasts and anchored yourself in value, a new and powerful perspective emerges. The constant market volatility which terrifies the average investor is no longer a threat. It is an opportunity. This is the fourth pillar of Buffett's philosophy, using the currency of uncertainty to profit from the fear and greed of others. Market swings, often triggered by some surprising economic event or a failed forecast, create massive dislocations between price and value. The prepared investor, who has done their homework and has cash on hand, can use these moments of collective insanity to make the investments of a lifetime. Buffett's famous maxim, "Be fearful when others are greedy, and greedy when others are fearful," is the ultimate strategic application of this pillar. And there has been no greater test and no greater triumph of this principle than his actions during the 2008 financial crisis. As 2008 dawned, the global financial system was a house of cards poised to collapse. Years of reckless lending in the U.S. housing market, packaged into complex and opaque financial instruments, had spread like a cancer throughout the balance sheets of the world's largest banks. When the housing market finally cracked, the crisis began. In September of 2008, the investment bank Lehman Brothers declared bankruptcy, an event that sent a shockwave of pure terror through the markets. Credit markets froze. The stock market went into free fall. The economic forecast was no longer just for a recession, it was for a potential second Great Depression. The headlines were apocalyptic. Pundits on television spoke with grave certainty about the complete and total collapse of capitalism. Fear was palpable. It was a time of maximum pessimism, a moment when the vast majority of investors were selling everything that wasn't nailed down, desperate to convert their assets into the perceived safety of cash. In this vortex of panic, a telephone rang in the offices of Goldman Sachs, one of the most prestigious investment banks on Wall Street. The firm was sound but was facing a crisis of confidence. It needed a stamp of approval, a sign to the world that it would survive. So its CEO, Lloyd Blankfein, made a call to Omaha, to the one man whose name was synonymous with stability and value, Warren Buffett. While the rest of the world was panicking, Buffett was calm, rational, and ready to act. He had been preparing for this moment his entire life, by maintaining a fortress-like balance sheet at Berkshire Hathaway and hoarding cash. He analyzed Goldman's situation not based on the terrifying headlines, but on the long-term fundamentals of its franchise. He saw a durable business that was temporarily engulfed in a system-wide panic. He then struck one of the most brilliant deals in financial history. Buffett invested $5 billion in Goldman Sachs. But he didn't just buy common stock. He bought preferred stock that paid him a massive 10% dividend annually, $500 million a year guaranteed. On top of that, he received warrants that gave him the right to buy $5 billion worth of common stock at a fixed price for the next 5 years. It was a deal that was only available to someone who had cash and courage when everyone else had fear. A few weeks later, he made a similar deal with General Electric. Then, a few years later, as the crisis lingered, he made another multi-billion-dollar injection into a reeling Bank of America on similarly spectacular terms. He was not acting as a speculator. He was acting as a provider of capital in a capital-starved world, and he demanded and received extraordinary terms for doing so. He was being greedy, as his maxim dictates, when others were terrified. The 2008 crisis was the ultimate failure of economic forecasting, and for Warren Buffett, it was the ultimate opportunity. His ability to act decisively in the face of overwhelming fear, a fear fueled by the very forecasters he had always ignored, netted Berkshire Hathaway billions of dollars in profits and cemented his legacy as the world's greatest investor. Buffett's ability to act so decisively during the 2008 crisis stems from his deep understanding of the psychological biases that paralyze most investors during a panic. The two most powerful forces at play in a market crash are loss aversion and recency bias. Loss aversion is the principle, demonstrated by psychologists Daniel Kahneman and Amos Tversky, that for most people, the psychological pain of a loss is about twice as powerful as the pleasure of an equivalent gain. Losing $100 feels as bad as gaining $200 feels good. In a plunging market, this bias goes into overdrive. Every glance at a portfolio statement is an excruciating emotional blow. The brain's primary impulse is to make the pain stop, and the quickest way to do that is to sell. This is a primal emotional reaction, not a rational financial one. Investors sell at the bottom not because they have coolly calculated that prices will go lower, but because they can no longer bear the psychological pain of watching their net worth decline. Recency bias is the tendency to overweight recent events when making judgments about the future. When the market has been falling for weeks, as it was in late 2008, recency bias convinces investors that it will keep falling indefinitely. The recent past is projected forward as the most likely future. This is what creates the feeling of hopelessness at the market bottom. The idea of a recovery seems impossible because the most recent and vivid evidence points only downward. The negative economic forecasts from the media pour fuel on this fire, providing what seems like a rational justification for the emotional belief that the sky is falling. Warren Buffett's entire intellectual framework is designed to be an antidote to these biases. His focus on a business's intrinsic value provides an anchor of rationality in a sea of emotion. He knows what Goldman Sachs is worth based on its long-term earnings power, so the short-term price gyrations are less terrifying. He is playing a different game. While others are reacting to the pain of their recent losses, he is focused on the opportunity presented by the price. He consciously inverts the recency bias. He knows from a lifetime of experience and studying market history that periods of extreme pessimism have always, eventually, been followed by periods of recovery. He understands that the moment of maximum fear is also the moment of maximum opportunity. His rational brain, fortified by decades of disciplined thinking, is able to override the primal screams of his emotional brain, allowing him to be the calm buyer when the world is in a panic-selling frenzy. To systematically exploit the opportunities created by market panic, one needs a pre-planned strategy. It's not enough to simply decide you'll be brave when the time comes. You need a mental model that dictates your actions. This is the fat pitch strategy, an analogy Buffett borrows from the baseball player Ted Williams. Williams was famous for dividing the strike zone into 77 smaller squares and knowing his batting average for a pitch in each square. He resolved to only swing at pitches in his, quote, happy zone, where his chances of getting a hit were highest. For an investor, this translates into a patient, opportunistic approach. Step 1 is to do your homework during the boring times. You create a watch list of wonderful businesses that you have already thoroughly analyzed using the 10-year test. You know their moats, you trust their management, and most importantly, you have calculated a conservative estimate of their intrinsic value. You know the price at which they would become a compelling investment. Step 2 is the hardest part. You do nothing. You wait. You let the market go about its business. You ignore the minor fluctuations and the daily noise. You might go months, or even a year or more, without making a single purchase. This requires immense patience and discipline. You are Ted Williams, at the plate, letting the marginal pitches go by, even if the crowd is yelling at you to swing. Step 3 is to monitor the market not for predictions, but for emotion. You are watching for a fat pitch. A fat pitch in investing is a moment of mass panic or euphoria, often triggered by a major economic event or a failed forecast, that causes the price of one of the great businesses on your watch list to diverge dramatically from its underlying value. In 2008, the entire financial sector became one giant fat pitch. Step 4 is to swing with conviction. When a pre-vetted company on your list is offered to you at a significant discount to your calculated value, say $1 of value for 50 cents, you act decisively. You don't nibble, you invest a meaningful amount of capital. Because you have done the homework in advance, you can act quickly and with confidence, while others are paralyzed by fear and uncertainty. A crucial component of this strategy is step 0. Always have dry powder. You must strategically maintain a cash position so that when the fat pitches inevitably come, you have the ammunition to swing. Holding cash during a raging bull market can feel foolish, but it is the price you pay for the option to buy assets at bargain prices when the world is on fire. The fat pitch strategy transforms you from a market victim into a market predator, patiently waiting for the emotionally driven mistakes of others to serve up the opportunity of a lifetime. The path of the 99% in a crisis is the exact opposite of the fat pitch strategist. It is the tragic path of the panic seller. This individual experiences the full force of loss aversion and recency bias, with no rational framework to protect them. As the market begins its decline, the panic seller is initially frozen, hoping for a rebound. As the losses mount and the negative headlines intensify, their anxiety turns to terror. They remember the pain of previous downturns and project it forward. The dominant thought is, I have to get out before it goes to zero. Finally, usually near the point of maximum pessimism, they capitulate. They sell all their holdings, often at the worst possible prices. In that moment, they feel a sense of relief. The pain has stopped. They have converted their volatile stocks into the comforting certainty of cash. But their ordeal is far from over. By selling, they have turned a temporary paper loss into a permanent, irreversible loss of capital. Now they are on the sidelines, waiting. They tell themselves they will get back in when there is more clarity, when the economy is on a firmer footing. They are waiting for a positive forecast to give them permission to invest again. But the market does not wait for clarity. It bottoms in the midst of uncertainty and begins its recovery long before the economic news turns good. The panic seller watches in disbelief as the market rallies. They are paralyzed, convinced it's a dead cat bounce or a bull trap. By the time the recovery is well established and the headlines finally turn positive, the market has already surged 30, 40, or even 50% from its lows. Now, driven by the fear of missing the entire recovery, they buy back in at prices significantly higher than where they sold. They have perfectly executed the investor's dance of death, selling at the bottom and buying near the top. This cycle not only devastates their portfolio returns, it inflicts deep psychological scars, making them even more likely to panic during the next downturn. It is a self-perpetuating cycle of wealth destruction, all born from the inability to separate emotion from investment decisions in a crisis. The financial advantage of Buffett's contrarian approach is mathematically captured in Benjamin Graham's central concept, the margin of safety. This is not just a vague idea about being careful. It is a quantifiable buffer that is the true source of reduced risk and enhanced returns. When you conduct your valuation and determine a business is worth $100 per share, and you wait until a market panic allows you to buy it for $50 per share, you have a $50 margin of safety. This margin is what protects you. If you were wrong in your analysis and the business is only worth $80, you still have a $30 cushion. If an unexpected negative event occurs and the company's value falls, your margin of safety absorbs the blow. It is the shock absorber for your portfolio. Risk for Buffett is not market volatility. That is opportunity. True risk is the probability of a permanent loss of capital. The panic seller who buys at a high price with no margin of safety and sells at a low one is taking on maximum risk. They are guaranteeing a permanent loss of capital. The intelligent investor who insists on a large margin of safety is taking on minimal risk. By buying $1 of value for 50 cents, you are simultaneously increasing your potential upside and dramatically decreasing your potential downside. If the company's value simply returns to what it was originally worth, you double your money. If it continues to grow, your returns are even greater. The margin of safety is the financial manifestation of being greedy when others are fearful. It is how you translate the psychological failings of the crowd, driven by their belief in fleeting forecasts, into a tangible, mathematical, and massive long-term advantage. We have arrived at the final, and perhaps most crucial pillar of the entire Buffett philosophy. It is the linchpin that holds everything else together. We have seen why forecasts are illusions, why the activity they spur is poison, how to build a fortress of value, and how to profit from market panic. But none of these strategies can be executed successfully without the fifth pillar, the unfair advantage of temperament. Buffett has famously stated that to be a successful investor, you don't need to be a rocket scientist. Investing is not a game where the guy with the 160 IQ beats the guy with the 130 IQ. What you need is the temperament to control the urges that get other people into trouble in investing. This final pillar argues that the ultimate defense against the noise of the market is not a complex algorithm or a secret formula, but a specific, cultivated psychological disposition. Mindset trumps method. To see this principle embodied, consider Buffett's long and incredibly profitable investment in the Washington Post Company. He first invested in the company in 1973. At the time, the market was in the midst of a brutal bear market. The country was reeling from the Watergate scandal, and the newspaper industry faced significant challenges. The company's stock had been crushed. Most investors, looking at the gloomy short-term forecasts for both the economy and the newspaper business, wanted nothing to do with it. But Buffett, as always, ignored the forecasts and focused on the business. He saw in the Washington Post an institution with a powerful, almost monopolistic franchise in its market. It had a deep moat built on journalistic integrity and local dominance. He calculated its intrinsic value to be far, far higher than its stock price. So he invested heavily, becoming a major shareholder and a member of the board. What happened next is the critical lesson in temperament. The stock went nowhere. For the next 3 years, the market continued to ignore the value that Buffett saw. The stock languished. A typical investor, even one who had done the initial analysis correctly, would have become impatient. They would have questioned their own judgment. They would have been tempted by other, more exciting stocks that were rising. They would have listened to the renewed forecasts that newspapers were a dying business. The urge to sell, to cut their loser and move on would have been immense. This is where temperament comes in. Buffett's conviction was based on his own analysis of the business's value, not on the market's daily validation of his opinion. He knew he was right, and so he waited. He possessed the patience to let his thesis play out over years, not weeks. And wait he did. Eventually, the market woke up to the immense value of the Washington Post. The stock began a multi-decade ascent that would turn Buffett's initial $10 million investment into a stake worth over $1 billion, a return of more than 100 to 1. This colossal victory was not a result of brilliant market timing or a complex trading strategy. It was the direct result of a single, simple quality: the temperament to buy a wonderful business at a fair price and then have the patience to hold it, through thick and thin, for a very, very long time. The failure of those who lack this temperament can often be explained by another set of powerful psychological biases. The first is the Dunning-Kruger effect, a cognitive bias in which people with low ability at a task overestimate their ability. In investing, this is rampant. Many forecasters and amateur investors are, in a word, unconsciously incompetent. They don't know what they don't know. They mistake a little bit of knowledge for deep expertise, leading to extreme overconfidence in their ability to predict the market or pick stocks. They create elaborate, complex models and believe they have outsmarted the system, but they lack the foundational wisdom to understand the system's inherent unpredictability. This intellectual hubris makes them brittle. When the market inevitably proves their complex forecast wrong, they have no bedrock of temperament to fall back on, and they are just as prone to panic as anyone else. The second bias is the bias from liking/disliking. We are all susceptible to believing information that comes from people or sources we like, and dismissing information from those we dislike regardless of its objective validity. In the financial world, this means we tend to follow the advice of charismatic, confident-sounding pundits we see on TV, the ones who tell a good story and make us feel optimistic. We seek out forecasts that confirm our existing beliefs, confirmation bias, from people we find agreeable. Conversely, we may dismiss a bearish but well-reasoned argument from a source we find unpleasant or boring. A stable temperament creates a crucial emotional distance from this trap. The investor with the right mindset evaluates information based on its logic and evidence, not on the likability of its source. They are indifferent to charisma. They care only about facts and reason. They understand that the market does not care about your opinions or who you like. A cultivated temperament is the filter that purges these emotional distortions from the decision-making process, allowing for a clearer, more objective view of reality. The actionable mental model for developing this winning temperament is perhaps Buffett's most profound contribution to the field of practical psychology, the concept of the inner scorecard. He often asks students, would you rather be the world's greatest lover, but have everyone think you're the world's worst lover? Or would you rather be the world's worst lover, but have everyone think you're the world's greatest lover? The point of the question is to force you to decide what matters more: your internal reality or your external reputation. The vast majority of people, especially in the age of social media, live their lives according to an outer scorecard. Their success is measured by what other people think of them. In investing, this is a fatal flaw. To cultivate an inner scorecard, you must follow a deliberate, three-step process. Step 1 is to explicitly define your own internal metrics for success, completely independent of external validation. Your scorecard shouldn't be based on whether your stock went up this quarter or whether a pundit on TV praised your pick. Instead, it should be based on your process. Ask yourself questions like, did I act rationally and without emotion? Did I stick to my circle of competence? Did I thoroughly research the business? Did I buy with a sufficient margin of safety? These are the things you can control. The market's short-term reaction is not one of them. Step 2 is to consciously identify and label the inputs of the outer scorecard: the daily price of your stock, the performance of the S&P 500 this month, the opinions of your friends and colleagues, the headlines in the financial news. These are all external metrics. They are the judgment of the crowd. By mentally tagging them as outer scorecard data, you can diminish their emotional power over you. Step 3 is to make a daily, conscious choice to live by your inner scorecard. When a stock you own goes down after you buy it, the outer scorecard says you made a mistake. The crowd thinks you're a fool. But your inner scorecard might say you succeeded, because you followed your disciplined process perfectly. Conversely, if you buy a speculative stock on a hot tip and it doubles, the outer scorecard says you're a genius. But your inner scorecard should tell you that you failed, because you gambled and got lucky. You did not follow a sound process. Living by the inner scorecard is the key to developing the patience of a true long-term investor. It provides the psychological fortitude to hold a position like the Washington Post for years while it goes nowhere, because your conviction comes from your own deep analysis, not from the market's fickle applause. It is the ultimate source of emotional resilience and the unfair advantage that allows you to operate calmly while the rest of the world is losing its mind. The path of the 99% is often walked by those who lack this inner-directed temperament. We can call this archetype the intellectual gambler. This is often a highly intelligent person, a doctor, a lawyer, an engineer, who has been successful in their own demanding field. They assume incorrectly that their high IQ and success in one domain will translate directly to success in investing. They are a prime victim of the Dunning-Kruger effect. The intellectual gambler scoffs at simple, long-term strategies. They believe they are smart enough to outwit the market. They build complex spreadsheets, subscribe to expensive data services, and create intricate models to forecast economic trends or a company's earnings. Their approach is all brain, no gut. They have the intellectual horsepower but lack the emotional discipline. When the market moves against them, their intellectual arrogance shatters. Their complex model, which they believed was infallible, is proven wrong. And because their entire strategy was built on the shaky foundation of their own intellectual pride, they have no bedrock of temperament to fall back on. Their confidence evaporates, and they are gripped by the same primal fear and panic as the most unsophisticated investor. They dump their positions, vowing that the market is irrational and rigged. They are brittle. The simple, patient investor, who buys a good business and holds on, is anti-fragile. Market volatility and the failure of forecasts actually make them stronger by presenting opportunities. The intellectual gambler, for all their intelligence, fails because they lack the humility to accept the future's unpredictability and the temperament to endure its storms. They prove, once and for all, that in investing, a stable disposition will always beat a volatile genius. The ultimate financial consequence of mastering this final pillar, of developing a temperament that allows for true long-term holding, is the full, unbridled unleashing of the most powerful force in the financial universe, uninterrupted compounding. The entire structure of Buffett's philosophy, ignoring forecasts, focusing on value, acting with courage and panics, and maintaining a patient temperament, is designed to achieve one single goal: to buy great assets and then get out of the way, allowing them to compound for as long as possible. Picture two investors. Investor A is the intellectual gambler, the market timer. They are smart and active. They manage to generate an impressive 12% annual return. However, every 7 to 10 years, a recession hits, a scary forecast spooks them, and they sell out of the market, staying in cash for a year or two before getting back in. Each time this happens, they interrupt the compounding process. Investor B is the temperament king. They simply buy a portfolio of great businesses and hold them. They achieve a more modest 10% average annual return, but they never sell. They ride out every bear market, every panic, every scary headline. Their compounding is never interrupted. After 50 years, Investor A, despite their higher annual returns in the good years, would have a fortune significantly smaller than Investor B. The interruptions are devastating. A single year or two out of the market can lop decades of effective compounding off the end result. The person who allows the eighth wonder of the world, compound interest, to work its magic unimpeded will almost always triumph over the person who thinks they are smart enough to dance in and out. This is the final, tangible proof. The reason Warren Buffett is one of the richest men in the world is not just because he is a great investor, but because he has been a great investor for an incredibly, unnaturally long time. His temperament gave him the staying power. It allowed him to keep his capital working, compounding, and growing, decade after decade, without ever being shaken out by the noise of forecasts or the fear of volatility. That is the final promise. Temperament is not just a psychological advantage, it is the ultimate financial weapon. You have just spent this time rewiring the very foundation of your financial mind. You have absorbed a framework that liberates you from the anxiety-inducing, wealth-destroying machine of market prediction. You have acquired the intellectual tools to distinguish between the financial noise that fills the airwaves and the durable, knowable value that truly builds wealth. This is not just a collection of tips, it is a complete operating system for rational decision-making in an irrational world. You now understand that the future is not something to be predicted, but something to be prepared for. But what we have just built is a single, powerful fortress in a much larger landscape. Warren Buffett's system of thought is not a series of isolated ideas. It is a complex, interconnected network of mental models, a latticework of wisdom where each concept supports and strengthens the others. You have just mastered the foundational pillar of ignoring the macro, of rejecting forecasts. But how does this connect to the specific, granular techniques he uses to analyze a balance sheet, or the psychological tricks he employs to negotiate a multi-billion-dollar deal? How does the principle of the inner scorecard influence the way he structures his management teams? You have built the engine. But an engine is useless without a chassis, a transmission, and a steering wheel. The journey of mastering this complete mental arsenal is a process of connecting the pieces, of seeing how the parts form a seamless, integrated whole. The video that is now appearing on your screen is not just another piece of content, it is the next piece of the map. It is the crucial link that connects the philosophy you have just learned to the next level of its practical application. It is the bridge from the ake, kupuk, ge, beda, kupuk, ake, treen, senti, kupake, treen. How? The decision to click is not about watching another video. It is a choice about who you want to become. It is a commitment to continue your ascent, to complete the lattice work, and to transform yourself from a passive consumer of financial information into a disciplined, rational architect of your own financial destiny. The next piece of the puzzle awaits.